Okay, good morning. Today is Saturday, the 26th of November, 2022. And today we will be having a revision session where we'll be discussing on various questions that are brought to the table that requires guidance, specific answers, and deliberation, and also on probably areas that are contemporary that further exploitation might be required. Okay, and on this note, you guys will be doing much more of bringing forward questions for clarification of our answers, and I will try to more or less make justice to it as far as practicable. The floor is open for you guys now. Over to you.
Okay, good morning, sir. Thanks so much. From my hand here, I was able to look at about, I think about two or three topics. I mean, 2 or 3 standards. The first one has to do with the what's it called, IS 8, which speaks to the changes in accounting policy, accounting estimate, and errors. And I was able to get what's it called, so many things from the from the video lecture. However, I still have some areas where I'm a bit confused and which I need further clarification. Then after that, I also have some issue with regards to the impairments. Impairment of assets when it comes to the CGU, like exactly the CGU aspect of it. And as regard the tax, IS 12 as well, I'm still having some little, although I'm clarified it's a large portion of it, although I'm still having some little issues. So to start with, let me start with I think I still have one more. Changes in foreign exchange transaction. Concerning the changes in, let me start with this. Changes in foreign exchange transaction. When I started checking the video, I realized that there was a noise in the, like, not even a noise, a music. So I could not even pay attention to, so my attention was on the music rather than the, rather than the lecture. So I don't know how you can help me in that regard, because I could not, because listening to your teaching and that music, that background music is not helping me. So I had to just, at a point, I was trying to manage, but at a point I just had to stop watching it, hoping that when I discuss that with you, maybe
That
you can
means
just...
you're a music person. You like music more than reading.
I like music.
Okay, you have to work on the psychology. The only difference is that because the approach to that was more or less like facts and ask questions. Okay, and that's the approach, and it's just to put some background. Only that unfortunately the background music was far higher in tone or in volume. Okay,
Exactly.
but again, you have access to the material, which I think I posted during the week again. I can also share it again, which you can read. I just take time to watch the video. But again, if you have other specific questions on it, please, you can ask now. But let's pick it one by one.
Okay.
Let's pick it one by one. Let's start with requirement of IS 8. Okay, which you mentioned. Therefore, in that, we might be looking at formulation of accounting policies.
I can't see your screen. I don't know if you are sharing the screen.
Okay, I'm sharing the screen.
Yeah, I can see the screen somewhere. Maybe it's a network.
Probably you are using phone or network. Okay, formulation of accounting policies. How do we consider the effect of changes in accounting policies? Similar changes in accounting estimates. and correction of accounting errors. In this case, we are considering it as a material error or material errors. Okay, what's your specific questions about that? Slamo, we are waiting your question on that.
Okay, sorry. I never knew I was muted. So what's it called? I'm still having issue with regards to how to differentiate between changes in accounting estimate and changes in accounting policy. And the reason is, at a point you were talking about IAS 40, where they were applying, where they had to change from, where they have to change the model from investment property to PP. So at the point of changing, so at that point, you try to relate it to accounting policy, and at the point, you also related it with accounting changes in accounting estimate. So I was a bit confused about. So probably I will need to get a very clear explanation that can actually aid my understanding as regard the difference between changes in accounting policy and changes in estimate itself. So if you are saying changes in estimate, are we actually looking at the the estimate, like let's say percentage, or maybe the method? For example, in case of depreciation, are we looking at when a firm is changing from one method to another, or is increasing its rates? For example, let's say the useful life of the asset or the depreciation rate. Are we saying? So I just want to, I'm not really clear with that aspect. Although I understand that of error relates to retrospective adjustment where it is possible.
Okay. Let me show you by way of diagram.
Sorry, but I need to log in with my laptop. I can't see this screen. I'll join. So.
Okay. If this is a timeline, I can have it divided into 3. And here, you have accounting policies. Yeah. You have accounting estimates. And here, you have accounting errors. Okay, what is pivotal to them all is accounting estimates. Now, we all understood what accounting policies are because the borders on set of principles. Okay, they are more or less like guidelines. Okay, they are more or less like basis to which we account. They are more or less like conventions and including practices. All of these are things that underlie the way and manner we prepare and will present financial statements. Okay. Now, with respect to accounting policies, anything that serves as a basis of measurements okay, we'll consider it as an accounting estimate, which could include method, which could include valuation basis, which could include pricing, costing, and etc. Which means they are more or less like a methodology to obtaining an estimated value for what you more or less have to recognize based on your accounting policy. But there's a thin line in between them that sometimes it might be practically difficult to separate when an event constitutes an accounting policy or constitutes an accounting estimate. And there is a guidance in IAS 8 that says that where you find yourself in such a situation, you should much more treat it as an accounting estimate. That is when it is much more practically difficult, or it is practically impossible to expressly separate them. But 99% of the time, you can easily separate them. And I'll give an example. If you change method of depreciation, it constitutes a change in accounting estimates. Why? Because depreciation itself is a systematic way or manner of allocating the historical costs of an asset. What that means that depreciation are expected to mimic the pattern of usage or consumption. Now, but that doesn't mean that all changes in methodology is a change in accounting estimate. I'll give you an example. If any of you have gone to the self-paced video and the source material with respect to IFRS 6 that borders on mineral resources, exploration and evaluation of mineral resources, natural resources, okay? And also, if you are familiar with oil and gas accounting, which I also discussed there, with respect to things like full costs.
Sorry, sir. I think we've not done IFRS 6, and we don't have them.
No. At the earlier stage, those are the self-paced. If you go back, you can see them. I can see share it with you. Okay, full costs and successful effort methodology. And these are the methodologies to accounting for development costs in oil and gas accounting. Okay, now, these are also methodologies, but these methodologies are more or less in tandem with accounting policy, which means a policy that borders on capitalization and allocation of that capitalization of development costs to various fields based on whether it's successful or not successful. You allocate it across, which is based on the full cost, or you allocate only based on successful fields, and those that are unsuccessful are expensed immediately. Which means in this case, when you change a change in full cost to successful efforts method, or vice versa, is a change in accounting policy. And the reason being that the full cost methodology or successful effort methodology are not necessarily to reflect basis of measurements, but rather they are policy regarding either do you capitalize development costs depending on successful fields, or depending on all fields that constitute exploration and evaluation of mineral resources. And therefore, we need to have that clarity. Another clarity that I want to bring to you is with respect to the discussion I made under IAS 40 versus IAS 16. IAS 40 deals with investment property. IAS 16 deals with owners occupied property. And this has two methodologies, cost and fair value. This has two methodology, cost and evaluation method. The cost here and the cost here are the same. But the fair value here and these are not the same. That's number one. Now, what am I driving at with respect to changes in the policy or changes in an estimate is that if, for example, you change the use of cost, you are using cost model for your investment property before, and you change to fair value model, or you are having fair value model before, and you change to cost model. Any change between this is a change in accounting policy. Likewise, under IAS 16, when you change from cost to revaluation or from revaluation to costs, such a change is equally a change in accounting policy. But what happens where there's a change from cost model under IAS 16 to fair value model under IAS 40? Can we say it's a change in accounting policy? The answer will be no. It's not a change in accounting policy. Or vice versa. Why? I give an example. Imagine you have owner-occupied property before now. which you make use of costs. And that was used for your administrative block. But you have now developed a new head office in Atlantic. And you have moved to that new head office. But your old office, the structure, you decide to convert it to investment property by leasing it out for renters and also to take advantage of capital appreciation. In that case, it's no longer owner-occupied property, but now investment property. And what that presupposes is that for the first time, you are having investment property and you are picking a policy of fair value. Therefore, in that case, we can regard you moving from cost model under IAS 16 to fair value model under IAS 40 and say there is a change in accounting policy. We say no. Rather, there's a change in the pattern of usage or consumption of that asset, which is no longer for your office use or for production or for renting services, but rather for capital appreciation and renters. And therefore, such a change is a change in accounting estimate, which means you apply that change prospectively because it's a change in accounting estimates. Otherwise, you account for it retrospectively if it's a change in accounting policy. Samuel, I believe you understood it clearly now.
Yes, sir. I think so.
But again, the standard gave a guidance that in the 1% situation or rare situation where the event falls on the borderline, you rather treat it much more as a change in estimate than treat it as what? A change in policy. But that doesn't mean that because you don't have clarity. No, it's because only when the nature of that transaction is such that it will be difficult to expressly distinguish. In that case, the standard is in favor of changes in accounting estimates. Now, for accounting error, it's very straightforward. But also the standard understands that there's a borderline. There is a borderline between accounting estimate, changes in accounting estimate and changes in error. Let me give you an example. When there is a tax audit and there's an additional assessment, there is an additional tax resulting from tax audits. Should we consider that additional tax as what resulted from a change in accounting estimates or what resulted in a correction of accounting error? Now, naturally, additional tax is more or less considered to have occurred as a result of judgment in interpretation of the tax law or because of the lacuna usually associated with tax laws and its application. And therefore, where there's additional taxes resulting from tax audits, without any other evidence, we'll treat it as a change in accounting estimate. Why? Because also here, the standard recognizes that where there's a difficulty in ascertaining this, we'll treat it much more as a change in accounting estimate than a correction of accounting error. Now, will you say my interpretation of a law that is vague or that contain lacuna or loophole will have resulted in a wrong treatment, and you are saying I've committed accounting error? The answer is no. But there are also situations where additional taxes resulting from tax audits will be treated as accounting error. If you go back to our discussion on IS 12, I made it explicitly known that imagine the result of your additional taxes, or part of what contributed to your additional taxes is because when you are computing your tax, instead of you adding back depreciation, you deducted depreciation the second time. Or instead of you to have added back depreciation, it was omitted in your tax computation. And that is the source of the error, source of the difference in your tax assessment. That case will be treated solely as an accounting error, because this is not a judgment. It's like what you know that's supposed to be done was not done, and it's resulted in an error. But in this other case of changes in accounting estimates, what's supposed to be done was done based on my interpretation of the law, which has no clarity on the basis of the lacuna in the law. And in that situation, even if I succumb to the tax authority at the end of our tax assessment, or as a result of tribunal or court, in that situation, since there's no precedent to such interpretation, I will be seen to have more or less had a change in an accounting estimate. And what is the difference is that both accounting policy changes and correction of errors go with retrospective adjustments to your asset and liabilities as affected by the change or correction. Unlike accounting estimates that goes with prospective. And what is prospective is that the change should be applied to the current period and future periods if it relates to both, as if it's a transaction that naturally occurs in that period. But retrospective more or less comes with the fact that you need to go back in the period in which the measurement relates and try to adjust for it as if, with the benefit of hindsight, you know what will have been the result as of today, which means you go back to restate your position based on what you have now considered it to be today from the time being when the transaction or event occurred. And that's just the issue there, which means at both ends, IS 8 is in favor of treating any borderline events that cannot easily, expressly, practically be distinguished or separated as being a change in accounting policy or a correction of error will be treated solely as a change in accounting estimates. And that probably will have given more clarity. Any question again on this?
Okay, thank you very much, sir. It's clear now. So by implication, what that simply means is that just like in IS2 inventory, if we are changing from what's it called, the weighted average cost method to first in, first out, so that basically is what's it called, implies an estimate, like changing estimates. Am I correct, sir?
Okay, you are correct to a degree.
Okay.
Remember that IFRS is not rule-based, it's principle-based, which means I will not want to just always say, like setting rules to say, once you cross this is this, once, no. Try to understand the principle. What brings about the change from FIFO to weighted average, or vice versa, or to specific identification, or to standard costs? More than often, it will be as a result of changes in pattern of consumption. And in that situation, it will solely be treated as a change in accounting estimate. But sometimes the pattern of consumption may not have changed, and you are changing a methodology. If that is the case, and the underlying business model has not simply changed, it may be much more considered that is a change in accounting policy. Okay, but more than often, it is presumed in practical dispensation that a change in method of inventory is tantamount to a change triggered or necessitated by the pattern of usage, consumption, or the pattern to which you issue out such inventory out of stock, and also on the fact of the matter whether such stock or goods are more or less commingled. And there's another phrase I will have used also, which skipped my mind now, that they are interchangeable. For example, crude, petroleum products, and the like. You can't separate those ones that were old stock from new stock, unlike pack of Indomie and other things that you can easily separate based on the fact that the expiring date, production date differs. You can say that. But again, without anything to the contrary, and all things being equal, when there is a change in the inventory pricing methodology or inventory costing methodology, okay, such as changing between FIFO to weighted average or to standard cost to specific identification price, we might more or less treat them as a change in accounting estimates. Any other question?
Okay, that is clear, sir. And the second question actually relates to, what's it called? Actually, it's not related to, it's not directly related to the standard, but I just want to get the way you actually modeled that sheet. I mean that Excel sheet. I realized that whenever the deferred tax is in liability, it becomes red. Whenever it is asset, it becomes green. I don't know. So as a guide, I just want you to just I don't know if you can just put me through.
Okay.
Yeah,
That
so
one
I
is
just
that
want
one is
to, I
modeling.
love
That
the
one is
approach.
modeling. That one is modeling.
Okay.
It's just a logic. Let me see if I can pull out the Excel template.
Okay.
Let me see whether I can easily lay my hands on the Excel template. I'll open it so that you can see. It's just a logic. I use what we call conditional statement, if statement. If you have it, you can send it to my WhatsApp so that I can open it quickly now.
Okay, so I'll do that.
Send it to my WhatsApp. Let me just open it from there. Okay, but it's a conditional statement. Okay. One of those things I've also encouraged you guys to do is that one thing is to have knowledge, one thing is to have tools, one thing is to have skills. And therefore, the skills is the application of knowledge by harnessing tools to the understanding of the business problem. And you are using your skill to combine those three things together to provide effective solutions and also options. And you see that the same thing, if you have gone through our, if you have revised what we've done before, also on issue of preparing financial statements with a click of a button, you see that it's also similar tools I used to develop those templates whereby I can prepare course of financial statements in a day without sweating or anything. The only time I need to work is to develop the chart for the first time and more or less run the, the dynamic model. Going forward, I don't need to do anything other than upload balance sheet, upload trial balance, click a button,
Can check the
and
WhatsApp,
generate
sir.
balance sheet. Okay, I'm doing that now. Okay, let me share the screen. Can you see it?
Not yet, sir. Not yet.
Okay, wait. It's telling me field to start. Okay. Okay, you should be able to see it now. Can you see it now?
Yes, sir. I can see it.
Okay.
Yes.
Okay. Sorry, it's rolling. Okay. It should. I shouldn't have enabled it. Okay. But it should be okay now. Okay, probably what I'll do is okay, probably I'll reopen it and sign out to enable it. So let me stop it from running and reopen it without enabling it.
Okay, sir. So while we are waiting for that, I just want to ask concerning that IS-21. Are you saying you're going to provide us with another material, or we are still going to
No,
work on that?
I said I'm sending you the written material. That's my notes. And if you have specific questions, you can equally ask, especially as it affects most entities in Nigeria in the current dispensation that we find ourselves. Okay, with respect to having multiple market rates and some other things in addition to what exists naturally with respect to foreign exchange differences. Now, okay, we are back here now. Now, what we are trying to say is this. For example, if I try to tell you that property, plant and equipment is a liability, for example, let's say it's a liability item, okay, and I change it here, it switches what I have. Once it recognizes it, it switches it from.
I think you need to enable editing, sir.
Okay, sir. I hope it will not allow me to. I don't want it to run again like the other time. Okay. Okay. Now, let's say we are just putting the first item there. Let me say this is no longer property, plant, and equipment. Let me say it is loan. Let me say bank loan, or let me say debenture, for example. And debenture is a liability. Therefore, I change this class from asset to liability. Automatically, it changes the direction. Okay, what have I done here? Let me remove the password. I hope I remember the password I used for this one. Okay, now see what I've done there. If I can enlarge it, can you see this? This is what I've done. Just to use logical statement of if, we'll call it if statement. But again, what do I do? Is that if you come here, I said if cell D16 is an asset, therefore the difference between this and this should come to taxable. Otherwise, it should be 0 in taxable. But if it is a liability, the difference between this and this should come to deductible. Otherwise, in deductible, it should be 0. And that's what I've done there. Okay, which means at every point in time when I switch, it switches. And that's just it. There's nothing there again.
Yes, sir.
Another thing is, how do you do this drawdown? We'll do it through what we call data validation.
Yes, I think I can do that. But where okay. I'm having issue is where I need clarification is that color. Like when you select, for example, when you change asset to liability, it changes to red. So I've tried doing that just for.
Okay, no, that is okay. You just need to learn conditional formatting. There are many rules of conditional formatting there. Do you get what I'm saying now? All of this is conditional formatting.
Okay.
Yeah.
I'm actually okay.
I think I can send you a lot of resources on Excel.
Okay.
That's why you harness your knowledge of tools. Excel is a tool. Likewise, there are many other tools. You apply it on your knowledge and your understanding of the business problem and how to solve it. It's a combination of everything that turns to a skill. Do you get what I'm saying now?
All right,
Do you
sir.
get what I'm saying? Yeah.
Yes, sir. Thank you.
Okay.
So the next question on still on default on what's it called? Income tax.
Okay.
On this particular sheet, you mentioned something, and I would like to get a further clarity. Can you go back to the sheet, sir? So you mentioned, I think, yes, I think in what's it called, in that video, you asked a general question that why are we having 30% in 50 and we are having 32.5% for the tax, I mean, for the other items.
Yes.
And you explained, I just want to, just want to confirm if I actually understood what you said in the video. So I think what you said was that because they've enjoyed, because that's what's it called? That property, plants and equipment has enjoyed capital allowance. And what's it called? That's the more reason why we had to use the 30%. Was that just the reason, sir? Because you made reference to the, what's it called, a particular sheet, a particular model that you develop for computing taxable profits, where you said since capital allowance has been enjoyed,
with respect to the with respect to the PPE. So then there's no need to include the education tax of 2.5% in the tax rates. So I just want to confirm if that is actually what you meant in that particular session. So that is number one. Then number two, if we scroll down a bit, there's another session that relates to unrealized, like where we have losses, what's it called, tax credit and all of that.
This one, yeah.
Unutilized tax losses, unutilized investment allowances and all of that. I realized that we have always been having it under the tax base. So does this actually apply in all, in all cases? So is it that all of the carrying amount for unutilized tax losses are usually zero and all of that? So I just want to confirm that, because all of the estimations you did then on the video, they were actually on tax base. So we do not have the carrying amount for all of these unutilized.
Okay, thank you very much. Now, what is carrying amount? Carrying amount is the amount of an asset or liability for accounting purposes. Now, in your balance sheet, have you ever seen a section where you show your unutilized tax losses? Have you ever seen a section where you see unutilized tax credits or capital allowances? No. They are all for tax purposes. Therefore, they are in relation with your tax assessment. That's why they are balance sheet item for tax purposes, not for accounting purposes. You know, there are some balance sheet items for accounting purposes and not for tax purposes. For example, asset retirement obligation. There are some balance sheet items that both affect tax and accounting, only that their measurement basis may be equal or different. And there are some that only has tax effect and not accounting basis. For example, if you look at it, do you see any balance sheet item for unrealized FS gain or losses? No. You only see them for tax basis, because for tax purposes, they are not liable for deduction until they are realized. Therefore, which means they constitute a balance sheet item rather than income statement item for the period in which we recognize them based on accounting principle. I get what I'm saying now. Similarly, yes, to unutilized tax losses and capital allowance. Now, let me show you something. I think I've opened it. You know, when we started the session, we did this. Can you see it? Can you see this? Can you remember how to determine current taxes, which are actual taxes based on tax loss?
Yes.
Okay. Now you see all of this now. You see that in our discussion, things like capital allowance losses are not something you see in our balance sheet for accounting purposes, but these are things you see in the process of constructing balance sheets. For example, anything you see balance carry forward are balance sheet item for tax purposes. Are you getting what I'm saying now? Okay, and those are the things that are there. Now, the other one you want to discuss about is why 30%, 32 in some and others. Now, I'll give explanation. Okay, let me go back to that. Let me go back here. Now, look at it. How come, okay, let me return this back to property, plant, and equipment it was. Now, property, plant, and equipment, by their nature, you can see that it has 30%. 30% because your tax benefit from owning property, plant, and equipment is derived below the line. And what is below the line? Let me show you again. Remember, that this is accounting profits, 100 million. These are the 4 categories of adjustments that are done to arrive at profit adjusted for tax purposes. Now, this amount you have here, which is our assessable profit, is subjected to tax at 2% here, or 2.5% here. Can you see it? Now, as at that time, there's no effect for property, plant, and equipment with respect to tax deduction. Why? Because you are not allowed to have deducted the capital allowance before charging this tax, which means there's no tax benefit in relation with tertiary education tax when it comes to capital allowance. It doesn't give you any tax benefit because before capital allowance is deducted, that tax has been determined. Does that make sense? Which means the effects of capital allowance only affect you at the bottom line of reducing your taxable profit, which will now be subjected to tax at 30%. Which means if you have used 32.5 for capital allowance effects in our computation here, which is in our deferred tax, let me go back to our deferred tax session. Yeah, we will have gotten it wrong. But all of these items, for example, right of use assets by our law is not recognized for capital allowance purposes. It is the rental you pay that is deducted every year as an expense for tax purposes. Therefore, in that case, the whole effect of whatever right of use assets is will have been at the top end before tertiary education and company income tax that sum up to 32.5% are deducted or charged. The same thing for inventory, the same thing for receivable. What brings about receivable is your revenue. What brings about payable is your costs, including expenses and etc. Do you get what I'm saying now? Those are the things. Even your realized gain and unrealized gain, the effect of it, if it is taken for tax purposes, will be before charging tertiary education tax and company income tax. And that is the reason why we could see this as 30. Similarly, you will find out that unutilized tax losses, unutilized investment tax allowances, unutilized tax credit are also at 30%. Why? If you come back to our basis of computation, you find out that all of them are below assessable profits, whereas assessable profit has been used under company income tax to arrive at tertiary education tax, which means all of those ones have no effect on you absorbing your losses or relieving your losses, absorbing your allowances, and etc. And that's why those ones are 30%. Does that make sense to you now?
Perfectly, sir. Thank you, sir.
Yeah.
So,
which means if you go back to the video, I've also explicitly explained that. Any other question?
Okay, I don't know, Samuel, are you done?
you can
ask questions on the same thing that we've done so far.
Okay, my question is on share-based payments, sir. Actually, I really appreciate the lecture so far, the video when I watched it. There are some things that I come across that are really new and that I learned a lot. But it's just a quick one, just like a practical example. Just give me a guide to what could lead to modification and cancellation of a share base. That's one of
them. Okay. Now, first, we understood that share-based payments is a situation where part of compensation for consideration gotten from employees or from suppliers is that instead of you paying them cash, you are paying them in kind by delivering shares to them, or at a price that is below what the market is, so that the difference between what they are not paying in relation with those shares should commensurate with the value of the consideration they have offered in terms of services or goods. And also, that we can say is equity-based share-based payment, which means you will deliver shares to them, either by way of share grant or share option. There's a second aspect of it that you are still going to pay cash, but the cash will not be directly related to the value of goods or services, but rather it will be directly related to the value and movement in your share price at the settlement date, which we call cash settled share-based payments. Now, to fast track it forward, what brings about modification in share-based payments? Modification might come by way of situation where into the contract or during the vesting period, there might be an agreement that is usually initiated, but it doesn't stop it from being initiated by the other party, but usually initiated by the entity to carry out a modification, probably in terms of prices. Let me give you an example. As at the time share option was granted to employee for a period of 3 years, which is a service period, or we call it service condition, by way of passage of time. Now, 2 years into that scheme, there was initial projection that the share price of our company, which is currently at 10 naira, cannot rise more than 30% or maximum 50% over a 3-year period, which means the highest it can get to as at the vesting date is estimated and projected at 15 naira, which is 50% maximum. But going into the vesting period, 2 years after, 1 year to vest, there is a possibility that the share price might have tripled. It's now at 30 naira. The question then is, it becomes onerous to the company whereby you'll be giving shares at a price that is, probably you've quantified that you give them the share price at probably at 5 naira, where you have estimated that it's going to be 15 naira, which means the difference between 5 and 10 and 15 is 10. That 10 is a cost to you as a company. But now the cost is now probably going to get to as much as 25 naira because the share price is tending towards 30 naira. Therefore, it might be something the company might not be able to bear. And in the spirit of negotiation and engagement, the company might resolve to discuss with the employee to have the understanding that though the company had good intention of doing this for you, but again, it's now becoming onerous and at the detriment of the survival of the company or to even the existing shareholders. And therefore, the company might enter into an agreement to modify it in terms of the exercise price. Okay, moving it up. It can also be reversed, whereby the price might have crashed so that it's no longer valuable. It's now out of the money for the employee, which is a disincentive to them. Therefore, the company can decide to lower the exercise price, which is putting a modification to it. And the modification is not just about price. It can also be by the passage of time or the condition attached to it, which means it might be that it was initially a service condition. Now they have now modified to a performance condition, or from a performance condition to a service condition, or even from one service condition to another one by increasing it from 3 years to 5 years, or from 5 years to 3 years. Modification arises from a commercial consideration about the viability and other factors between both parties. And that brings about that. Okay.
Thank you, sir.
And I believe you understood the implication of where there's a modification, cancellation, and the like, and the accounting implication of it, all of those things were grossly discussed, illustrated with practical examples.
Yes, yes, sir. So I have another question. It's actually on IAS 16.
Okay, before IAS 16, are there questions on the three things we've covered so far? We've covered IAS 8, IAS 12, and just now IFRS 2. Any question on those ones before I can allow Esther to move further to another standard?
Okay, for me, I don't have questions, sir.
Any other person? Mr. Demi, welcome back. Madam Janet?
Thank you, Prof. It's good to be back. Well done, sir.
Okay. Any other question on those three before we move forward?
I apologize if this is something that was covered extensively, but my question is on the measurement of inventory. I do understand that some of the methods which we used to apply, have been phased out by IFRS. So just to ask quickly, which ones are the IFRS compliant ones that we can still use? I understand that FIFO is still there and possibly weighted average. Are there any other ones that IFRS permit? Thank you, sir.
Okay. From inception, IFRS have never permitted LIFO. LIFO is only a major methodology that is not acceptable under IFRS, or like US GAAP that give allowance for FIFO, only that you create what you call LIFO. You create what you call LIFO reserves. But time immemorial, IFRS have never, even as at the time Nigeria adopted IFRS, LIFO has never been a methodology acceptable. But there are other costing methodologies that are acceptable, which are first in, first out, FIFO, weighted average, standard pricing, standard costing, specific identification, and the like. Okay.
Thank you, sir.
Yes. Which other one? Okay, I think you can continue, Madam Esther.
Okay, thank you, sir. Okay, my question is just a practical example on this fixed asset schedule. If I just need a guide or a guide rather, for if you are reconciling your fixed asset schedule to your GA balance and to your fixed asset register, but make sure you notice there is any error. So how can one do the adjustments that will align, that will be practicable, that maybe auditors or so will not frown at it? Maybe you don't know the cause of the error, you try to trace the cause. It could be maybe from prior period and you noticed it when you do your reconciliation. So what guidance can you give, or like kind of that will help? So when auditors come, they will not say what you did was wrong or something. That's just my own personal.
No. Are you saying there was an error? Let us understand what's.
Yes, let's say you are reconciling your fixed asset register to the schedule, or maybe your GA balance. I notice there's a difference, maybe for right of use assets, or maybe tank farm. The amount there does not tally with the amount on the fixed asset register does not tally with the schedule.
First, have you investigated it to find out what is the source of it? Is there an error? Or what?
That's what I'm saying. That probably, yes, you could not trace it. Maybe from prior period, you don't know how the error come about. So,
and you've traced it, you can't get it.
Yeah. Yes.
Therefore, what you now need to do is to carry out asset verification, which means they should now verify the, what's it called?
Assets.
By way of physical inspection and valuation. If your accounting policy is not a valuation method, therefore, the only thing you just do is to do physical verification. And costing will not be part of it because you can't revalue. You just do physical verification and you compare items on your fixed assets register with items on ground. And anything that is on ground that's not on fixed assets, you bring it into books. Anything that is in the books and is not on ground, you recognize it. The question then is, the recognition can take effect immediately, which means it will be prospective, because it's at this point you observe that those assets are not in existence. But when it comes to assets that were physically existent and is not in your books, you must be able to ascertain from your other record or from knowledge of people that are making use of the asset to say, when was the what's it called, assets brought into the company, and which means that you can retrospectively more or less quantify what the cost was as at the time it was brought into the company, and try to correct for the depreciation, child depreciation up to date, which will come by way of restatement of account for that. But for the recognition, it can take effect prospectively. But for recognition of existing assets that were not in the books, you have to retrospectively restate them in the books, and cumulative effect of depreciation have to be charged up to that date of recognition.
Okay, thank you, sir.
Okay, let's have 5 minutes break and we'll come back to this session. Thank you very much. Okay, yeah, what's the next set of questions? I think Esther can continue. You wanted to start a new set of questions on a new standard. What is it?
Okay, lastly on my end, the question is on lease. It's a practical question I need to ask to get clarification from. So there's this lease arrangement we have of leasing out terminal, right? It's for a 1-year period, and there are associated costs related to the lease. Majority of the costs are capital in nature, capital expenditure, which we capitalize, and there's a particular cost relating to commission, because there's a third party through which we're able to get the lease, and the commission relating to that third party. Now, my question is, because in view of trying to avoid tax, because it's a startup company, in order not to pay a minimum tax out of a revenue, for paying minimum tax now is your income less investment income and all of that. So in avoid to kind of trying to deviate not to pay tax from revenue we should not earn, because there's a particular amount that was paid as commission. So now we didn't recognize costs relating to that, because the revenue is not being recognized over the period of 12 months. So now, would that be, will I say, is it right or is it proper not to recognize costs relating to that cost of commission now that relates to the revenue on a monthly basis? The idea was just to avoid being paying tax on that commission, because since we did not earn it.
Okay, first is this. First, let's try to have understanding. Are you the lessee or you are the lessor? Okay, that's the first question. Can you answer? You are the lessor. You own that asset.
Yes, sir.
And you are leasing it for 1 year.
Yes, sir.
Okay, first, let us clear that accounting aspect. Okay, as a lessor, you still have to determine whether it's an operating lease or finance lease. It's only from the angle of the lessee that you say there's nothing like such a delineation, which means it's a single lease. And you have to treat it as a right of use assets. Okay, but there's an exception to that also for a lessee. If it's of a short term, that is 1 year or less, or is of a small item, which we call a small lease. Okay, in that case, you won't apply the requirement of IFRS 16 with respect to right of use assets. Now, let us leave that and come to you as a lessor accountant. Now, with what I've had, leasing for a year is insignificant that from the condition that need to be fulfilled in meeting up a finance lease, such does not measure up, which means it's just a mere operating lease from the angle of you as a lessor. And therefore, your rental will be approved for as an income, whether it has been received or not. Okay, and that is that.
Yes.
Okay, now for the tax aspect, what I want to understand is this. When you lease through a third party, which means there's an agent that brings in the lessee to you, and that agent is entitled to earn something. Is
Yes.
that what I understood?
Yes, sir. Correct.
And the commission payable or paid to that agent, you don't to, there's a tax, what's it called, burden on it, which is VAT and withholding tax. Therefore, what's the issue about that?
No, the question I'm asking, as a startup company,
Yes.
let's say it's a loss-making company. I know
Yes.
from 4 years or above, more than 4 years, you will not be
You start to apply
minimum tax. Yes. Now, to
Yeah.
avoid paying minimum tax on that commission that has been paid out to an agent, the related costs, normally when you recognize revenue, you're supposed to recognize costs relating to the revenue. Now,
Yes.
to recognize the revenue, first of all, deduct that commission amount first.
Yes.
Before now recognizing revenue. Is that
No.
accounting?
You are not supposed to even deduct cost first. Revenue is your renter. Your agency cost is part of your direct cost of operation. It's not, you are not going to recognize revenue net of agency, no. Your revenue is the full amount of your rentals. Your commission is part of your cost of sales. Do you get what I'm saying now? That's that. Now, what I think you are saying is that because you're a startup, okay, and there's no minimum tax provision, okay, you now want to defer most of your costs relating to commission to future. I'm trying to understand what you're trying to achieve.
What I'm trying to achieve is this now. Because for we to avoid paying minimum tax, the commission.
No, to reduce the burden of your minimum tax, not to avoid paying minimum tax.
Okay, to reduce, let me use that. Yeah, that's the right word to use. The burden on the minimum tax. That commission payable to agent or paid to agent or deducted before recognizing the revenue on the lease asset. So now, is that treatment okay in terms of accounting?
No, it's not okay, because what I see you try to do is this. If your revenue is 1 million and your agency is 100,000, instead of you showing 1 million in your books, so that by the time you apply minimum tax, it will be 0.5% on 1 million. Whereas you want them to apply 0.5% on 900 because your books will have shown your net revenue as 900. You won't be able to do that for accounting purposes because a commission paid by way of agency fee is not netted off in the recognition of revenue. If you go back to IFRS 15, the 5-step model have no issue of net off or offsetting of cost in the revenue recognition process. Your revenue should represent your gross receipts from your principal activity in that light, based on that 5-step methodology. Does that make sense to you?
Yeah, thank you, sir. It's fine. Thank you very much.
Yeah. Any other question? Any other question? I'm expecting question. Madam Janet, I've not heard your voice. Mr. Lady, I've had your greetings and your chats. Okay. I want to hear more of, let's discuss more of practical consideration to all what we have discussed so far.
Hello, sir.
Yes, sir.
Okay, while we are waiting for others, I actually want to ask this question. Although it relates to IS8 actually, but I just want to, it's a practical case. What actually happened is we have a particular client that has a customer or a supplier. Let me say the supplier resides outside, like he's outside Nigeria. So from the contracts both of them had, when the supplier actually supplied the clients, the payment was not made immediately actually. So we had to, what's it called? We had to accrue for payables. We had to, what's it called? We had to recognize that as payable since the amount is yet to be paid. We are yet to settle the supplier who resides abroad. So now the supplier now gives a what's it called? He gave a, should I call it a concession or a kind of a I don't want to call it a credit note, but the concession he gave, the supplier gave the client is that it will reduce, what's it called, the amount of liability that they are owing them. Just, I don't want to call it a grant. I don't know the appropriate word to call it. Now, that concession that was given to the client, can we recognize that as a grant or what? I'm trying to look at the appropriate word and
Okay.
the appropriate we
now,
can actually.
If I can deduce what you said, you purchase goods from a foreign vendor.
Yes.
And you are owing that foreign vendor, have you?
Yes, sir. Yes.
And is the payment due? Is it already, the credit period, has it fallen due?
Yes, sir. Yes. Yes.
Okay, but you have not been able to pay.
Yes. But they now
the foreign vendor now incentivizes you by giving you a rebate in order to encourage you to pay so that they can just at least get something rather than nothing.
Yes.
Okay, which means, for example, you are owing $1 million. Probably the reason why you have not paid is because you are unable to source dollar based on the Nigerian situation. Okay, and the vendor is not saying, okay, I can waive $100,000 for you. Pay me now $100,000, have you? And your transaction is settled. Is that what you are talking about?
Sales have been made, have been recognized, and like they've recognized.
Right? Forget what has been recognized. We are talking of transaction. Forget accounting. Let's also talk commercial. You are owing $1 million before now. Now it has fallen due. You have not been able to pay due to one challenge or the other. The foreign vendor is now giving you an incentive to say, okay, pay me now $100,000. I waive $100,000. Is that what has happened?
Exactly.
Exactly. If that's what has happened, which means $100,000 is no longer a liability. Therefore, you have to recognize it as an income, which means you recognize it as an income. By doing what? You debit your payable account and credit your profit or loss, which means what is now left is now $100,000, which is now due for payment. Whether you are able to pay it or not is another thing. But the question then is there a condition to that 100,000? Is it a general waiver, or they are waiving that provided you can pay between now and 7 days, between now and 14 days, waive $100,000. If that is the case, you cannot be recognized until you meet that condition. But if it's just a general waiver that doesn't attach a condition to it, therefore you do that immediately. That's just it. Therefore, there's something like grant there, nothing like grant or anything. This is what deals with management of your payables.
Okay.
Which on the other side of the vendor is management of their receivable. It's part of working capital management.
Okay. Okay. So in addition to that, sir, so as part of their agreements, I think the vendor actually requires that the clients use that incentive or that concession to offset some expenses in the accounts. So we now realize that, for example, let's assume the expenses, for example, let's say admin expenses is about 50 million, and the concession that was given was, let's say, 70 million. So that concession now exceed the what's it called?
You see net income.
Okay, so that means, so are we going to still recognize that what was it called, the expenses in the statement of profit and loss, and see it as okay?
No, it's very simple. It's very simple. Offsetting doesn't change anything. In your books, without even saying you want to offset directly in the books, let me say you have a line. I don't know the nature of the transaction, but let me call it line. Let me say demurrage cost. You have it as 10 million. And the incentive given to you, which is a reduction in your payable, is 12 million. Therefore, there are two ways you can do it. If you want to do direct offset, it then means that if you offset 10 million against 2 million, against 12 million, there's a net 2 million income. And you can't put demurrage income because you're not collecting demurrages, which means your demurrage will be zero because you take 10 million out of the 12 million from the incentive to offset the demurrage of 10 million, which means 10 net 10 is zero. You can now have 2 million as being so incentive from our so. It goes under other income line. Simple. Or you maintain your demurrage at 10 million, and in other income, you also say incentive given by way of reduction in our payable on behalf of demurrage so 12 million. At the end of the day, your profit, your net income is impacted, all things being equal without tax consequence now, by 2 million increase in your profit line after netting off 10 million for the demurrage. Very simple. Except I also need to understand what you are trying to say.
Yes, it's clear. So I actually understand, although that was the way we actually treated the transaction. We had to apply offsetting. So where we had to offset all of those, and the excess was recognized in the other income. So, but I think what they were considering was maybe there will be a tax effect. Maybe if we should recognize.
That's secondary. That one is secondary. You know, we are not looking. We are not here to discuss tax. Any tax we want to discuss here are much more income tax accounting, not tax planning strategy. Is outside the scope. Do you get what I'm saying? But if you want to have engagement, I can have that discussion with you of this so that we don't miss it. This is more or less financial reporting session, not yeah.
Thank you very much, sir.
Okay, I think I saw Mr. Dennis saying thank you, Prof. Just wondering if we shouldn't be looking at IFRS 15 more to answer Esther's question. And I think that's what I also did with respect to revenue recognition and the 5-step model. Thank you, sir. And if there's any other question on that, probably you can raise it or on a follow-up to discussion we have here.
Thank you, Prof. I noticed that was what you did, sir. Just trying to call Esther's attention to that, rather than focusing more on leases.
Yes.
That could be what we just should.
Exactly. Yes. Yeah. Thank you very much, sir.
Thank you, sir.
Any question from you?
My next
Thank
question,
you,
sir.
Mr. Adini.
Yes.
You're
okay.
welcome, Esther. Thank you. My next question, sir. This thing was taught us while I was writing my final in ICANN. It was something I tend to disagree with the lecturer, and I've been looking for, someone like Prof to correct me if I was actually wrong or if it was my lecturer who wasn't getting it right. The issue borders on insurance. Now, it was a scenario that the lecturer gave us of an asset that was insured comprehensively. And he did say that there was an event, sort of an impairment, the asset being gulfed by fire towards the end of the year, towards the year end. And now, the area of disagreement was the fact that my lecturer said the time that the asset was consumed by fire, we were not to totally write it off. I think he said something like, we still keep it in the books. As inexperienced as I was, I thought strongly that yes, there is an insurance cover on it, but now that the asset no longer exists, that the right thing to do is to first write it off, to recognize that asset. And when we are able to claim the insurance, the claim from the insurance company, we can now kind of recognize, sort of asset. So my lecturer totally disagree with me. So, Prof, do you think I was making sense, or is there something I wasn't quite getting from the angle he was trying to come from? Thank you, sir.
Okay. Now, let me first of all try to go from this perspective. Let's start from the angle whereby we have an incident or an accident that has damaged an asset. And the first scenario we'll portray is that that asset is not insured. What do we do in that situation? What we do in that situation is that you immediately write off that asset or write it down to what is recoverable after your assessment of the effect of that damage. If it's a total write-off, you write it off totally, which is total damage. Okay, but if it's partial and you can repair, or this is the value you've quantified as being lost, therefore you write it down to what is recoverable immediately. Now, the second question then is, what if it is insured? Okay. Now, the question then is this. The asset is fully insured. The accident occurred on the 30th of December, 2021. And the asset is fully insured. Now, if you write off the assets, because it's an asset that is insured, you not write it off directly to profit or loss. It is presumed you write it off to insurance claim account, which is you create an account you call insurance claim. What does that mean? Immediately the accident occurs, you are going to report it. Whether you report it after the year end or anything does not matter. It is when it occurred, which is when did that event occurred. The event occurred on or before or after the reporting date. Therefore, the effect of that must be shown. Now, if the asset, for example, is 2 million naira, you are going to credit the asset account with the carrying amount of 2 million, assuming it's total write-off. and you debit it to insurance claim account, which is like an asset account, is a recovery account, provided it's fully insured, and you believe you can get the total sum assured. Okay, now let's assume the total sum assured is equal to the kind amount, which means the entire amount to be recognized to the insurance claim will now be an asset claimable from insurance company rather than charging it to profit or loss. I suspect that is the angle it's coming from. And again, I've assumed your claim and your kind amounts are in tandem. But what if your claim will be lower based on the fact that there's all this issue of no excess buyback clause, issue of depreciation even at the settlement of claim, which means at the end of the day, even though it's total write-off of 2 million, but what insurance can give you based on adjustments to cater for excess insurance clause, depreciation, and the like, you will get 1.5 million. It then means that the insurance claim is only 1.5, whereas you have more or less put in that account 2 million. It then means you have to write off 500,000 in that year, because the loss to you is net of insurance. Now, the third aspect is this: what if the asset is over-insured? What does that mean? You insure it for 2 million, you insure it for 3 million, but the kind amount is 2 million. Therefore, what happens? You have more or less recognized 2 million from your asset account to insurance claim account. Now, what then happens is this: based on the requirement of IS 37, when you are making provision contingencies and the like, you must be careful in recognizing your insurance claim in excess of the loss, which then means that it is only where it is practicable certain that you are going to get that 3 million, which is 1 million in excess of 2 million, that you can recognize such as an insurance claim, so that you can recognize a gain of 1 million in that period. Otherwise, you will only be able to recognize 2 million that matches with what you believe is reasonable that the insurance will be able to pay. Because again, remember, the principle of insurance does not support an insured profiteering from a loss event. That's why, for example, an insurance company would rather buy you a car than give you the sum assured in cash if they discover that buying that car is cheaper than giving you the sum assured. Insurance company would rather give you the money, which is the sum assured, which is the maximum amount they can pay out, if they discover that buying the car is more expensive, which then means that if you also now look at it in the reverse, which means to the insured, it will be unlikely to recognize profit arising from indemnification from an insurance policy over a lost event, which then means that in that situation, you will only recognize your insurance claim to the extent of what is probable to be recovered. Otherwise, any excess over it may be considered a contingent asset, which will only be disclosed depending on the nature of it, if it's highly remote or otherwise. But in this case, the simple thing is this: whether insured or not, the event that occur up to that reporting date must be captured in your financial statement. If it's not insured, it will be loss. If it's underinsured, it will be partial loss, and the other partial one will be recognition of insurance claim, which is a receivable. And if it's overinsured, it's more likely that you only recognize to the extent of the total loss you have rather than in excess of it, except it is more probable than not. Because again, when insurance companies discover, as I've explained earlier, that this will lead you to profit sharing, the convention and the rule of insurance is such that is to restate you to your initial condition at that event or loss event not occurred, not to make you profit in that policy. Does that answer your question, sir?
Thank you, Prof.
Any other question? Any other question? Samuel? Esther? What's the question, Esther?
No, not for me. I'm okay, sir.
Okay, Mr. Denny, what's your question? I can see talk on the background. I don't know whether Madam Janet, you're back. Any questions? Samuel?
No question for now, sir.
Okay. We need to gather more questions, because if there's no question, that means that abruptly we'll be bringing it to the hands. Again, don't limit the question to academic principle, but also extend it to practice.
Okay, sir. Riding on your last statement, so let me bother you a little, sir. It's a question for consultants like you. We currently have a sort of a small issue with the insurance on one of our, buildings. The rainstorm that happened earlier in the year affected part of the structure, and we went to the insurance company to
Hello?
after the usual report. Can you hear me, sir?
Yeah, you said something rainstorm affected part of the building. That's why we could hear you.
Oh, okay, sir. Yes, I said after the usual back and forth, the loss adjuster, the inspection, what have you, the negotiation with JB, and so the insurance company eventually made an offer, sent a discharge voucher, and there was this line item that was included, a deduction captured as betterment, charge, or deduction. At a quick glance, I figured that what they are claiming is the fact that, okay, you put this structure up 5 years ago. There have been wear and tear and what have you. Now there has been a damage by a rainstorm, and they want to, bring it to, a state that is as good as new. Now they surcharging us for, what was old. That they are renewing for us, and we took them up, on the basis that my insurance should cover any damage. That whenever there is a loss, you should, put me back to, I forgot what this clause we used to say in insurance back then in commerce.
To restore you back to your initial state at that event not occurred.
Exactly, sir. So I guess the part they are also coming from is that your initial state was not a brand new structure. So what's your take on this, sir? I mean, we have an argument on the fact that betterment clause was never in the insurance policy. and we're ready to go all out to say, okay, it's not there, and you can't at this point invoke the clause that we never agreed to. Just to hear your view. Yeah.
Okay, thank you very much, sir. Now, the first thing is this. Let us go back to the fundamental principle of contract and agreement. A contract usually or contracts are usually what arose from express agreement, which are later documented. But also there are general principles in contracts to which, where express agreement does not capture certain things, the question then is, are there implied agreements? For example, insurance company need not put it in any clause to say an insured cannot profit from any policy coverage, because the difference between indemnification and profit sharing. Indemnification is what insurance regulation anywhere in the world covers, not profit sharing from the angle of the insured. Let me give you an example. You insure a car you have used for 5 years, and there's an accident, total write-off, and you have insured it for 10 million. The insurance is now offering you, in quotes, 10 million. You're not saying, no, 10 million cannot buy this car. What I need is my car. The question then is, let us assume that the car that they can get, which is the same car, is only a brand new one. That will not be possible, and it's not supported by principle of insurance or the rules of insurance. Therefore, impliedly, the maximum value they can give you must equate the sum assured, which is to give you that 10 million, if not less, to cater for other things like betterment clause, SS buyback loss, and some other things like that. Now, let's leave that. Let's talk to your building specifically. First, what is a betterment clause? A betterment clause is more or less like a clause that states that an insurer will not pay for any repairs or replacement part that increases the value of an insured asset. Is to restore the value the way it is, not to enhance the value. The question then is, you insure an asset that over time its value has been consumed, either by way of usage, by way of passage of time, by way of physical deterioration, and etc. And you now expect the insurance company to restore it to new and enhanced value. It won't be possible. Which means, in that situation, there's always implied clauses, except where it is negotiated, to bring such betterment clause to zero as possible. But if not negotiated on the surface of the contract, the implied condition of any insurance now sail through. Do you know the mistake we make in this part of the world is that some people ask, what is the relevance of a broker in insurance? Remember, insurance contract or insurance as a whole find its fruit from law and regulations. Now, the nature of it is that ignorance of the law is not an excuse. That's why in this part of the law, people will tell you that, no, the reason why they don't like insurance is that when something happens, story will now come. Yes, to some extent, story, but sometimes it's not story. It's because you are entering into a contract you have little knowledge about without the aid of a broker. In some part of the world, you can't have a direct insurance where a company will go and insure directly with an insurer. You must go to a broker. Because of what? The broker will now have the responsibility as your advisor to guide you on things that you don't even know or you are not aware of. To say, sir, are you aware that when you insure this asset that depreciates in value, by the time the insured event occurred, are you aware that betterment clause applies with or without you agreeing on it? It's when you start to know that you can ask, okay, can you adjust forward your sum assured to take care of it? Or can you negotiate that such betterment clause should not apply? And if it will not apply, the insurance company cannot put it in its pricing so that the premium you will have been told to pay might be slightly different, which means will be slightly higher than what it is, which means everything is a commercial consideration. Are you getting it? It's because most companies, those who have the responsibility of carrying out such insurance stuff, might not understand it end to end. And insurance is one of the complicated, if not the most complicated business, because everything that surrounds insurance is risk. Everything from A to Z is risk. Risk to which most times you have limitation in quantifying. Either quantifying in terms of occurrence or severity. And therefore, we need to take that into consideration. In this case, I'll be biased because I belong to the insurance community more than to the general market, and probably because I have the understanding as an actuary. The issue is that that betterment clause will sail through. The only thing that will happen is if the insurance can now say, okay, let us look at it based on relationship, and forthwith, you are aware of it, and therefore our pricing may change if you don't want that betterment clause or you want to buy it back. For example, some of us are familiar with SS buyback clause for motor vehicle insurance, whereby if you do comprehensive insurance and don't buy back the SS clause, what it simply means is that some policies will have SS clause of 100,000. What it means is that any accident that you have that is not in excess of 100,000, insurance will not take responsibility, which means if they bash your bumper and everything just costs 80,000, it's your own problem. But if it costs 200,000, the insurance will pay 100,000, you will pay 100,000 because the excess buyback clause is 100, that which you didn't buy back. But if you bought it back, even if it's 5 naira, you can take it to insurance company and they take all of the bills. You can say that, and that is it. And I'll also say further that a betterment clause, which is a provision, you always find it in insurance coverage that borders on coverage of physical damage to assets. And usually it stipulates that where repairs or replacement of a damaged part will result in better than like kind of quality that's supposed to be of the existing asset that was damaged, the insurer are not expected to pay for such net improvements, which is what the essence of betterment clause is, because otherwise you are profit sharing. Which means if you have that, what's stopping you from instituting that damage yourself to always get enhancement of value? Do you get what I'm saying now? And also in this part of the world is where historical events and current event of an insured is not usually taken into consideration in pricing. That is why you could see that some people have net benefited massively in insurance coverage than others, because general pricing methodology is what we use for things like motor vehicle insurance in Nigeria, rather than using individual risk. For example, you see some young guys driving cars, and every time you see them having accidents, and insurance continues to take it up without impacting on their pricing going forward. Whereas if it's abroad, and somebody is paying as low as 5% insurance premium, which is 5% of the value as premium, some people are paying as much as 40%, if not more, depending on your assessment to that risk. And many factors, demographic and other factors are taken into consideration. Your loss experience, your age, your profession, your locality, your gender, your industry, and all of those factors in order to price you appropriately. And that is it. I know that Mr. Adeniyi will not totally be happy with my landing point, but that is the reality. Any commentary from you, sir?
Thank you, sir. Just that at some point I was thinking it's Prof consulting for my insurance company. But thank you, sir. All noted. God bless you, sir.
Okay. Any other question? Okay. I want to hear from Madam Janet. Mrs. Zaya, I've not heard from you. Let me just hear your voice first before I ask you questions, since you have not asked question. Can you unmute? Now, what happened to our network? Okay. Any other one from Mr. Balogun, Mrs. Yusufo?
None for me.
Okay.
No.
Mrs. Dari, we are waiting for you. You are back. Can you unmute? Let me hear your voice first. And if you have a question or I ask you a question, so that we can call it a day. Hello? It seems your network is bad.
Good afternoon, sir.
Okay, good afternoon, ma'am.
Yeah, my network is not too strong, so it's just going and coming.
Okay, what do you have for us? What do you have for us? Okay, I think it's okay. If there's no other question, I think thank you very much.
My question now is, I don't know if we've treated IAS 20 and 23, government grants and borrowing costs.
Yes, I've provided that before. I'm going to provide it again. I'm going to send you the self-paced video and the note and workbook on it again. And likewise, I'm going to send you that of IFRS 6 and oil and gas accounting with respect to full costing and successful effort methodologies.
Okay, sir.
Okay. And for those writing diploma in IFRS with ACCA and those writing IFRS certification exam with ICANN, I think ICANN is December 2nd, and diploma in IFRS is when? Mr. Adeniyi, when is that?
It's on the 5th, I think 5th or 6th of December, sir.
Okay, I wish all of you best of luck, and we'll continue to interact on our platforms and other medium. Okay, thank you very much, guys, and I wish you best of luck, and also in your day-to-day dealings as a financial advisor, business advisor, and financial reporting expert for various organizations. Okay, thank you very much. And before you go, I want to hear one or two things about your journey so far. Has it met your expectation? And what are the things that you've taken away from this all in all? Please, you can volunteer to talk at this point. Thank you.
Okay, good morning, sir. Let me start by talking. I really want to appreciate the fact that I'm a participant in this class. My expectations were actually overmet in terms of there are some areas when I was writing my ICANN, I knew, okay, these areas I'm good at it. And when you actually taught them, I was not seeing different things, very different from what I probably, their new standard, I know when I've passed the exam and probably some new things that have come up that I've not really come across with. And so far, my knowledge is really, will I say, enhanced in this program. And I really want to appreciate the fact that I'm actually a participant in this program, and I appreciate you as well for doing a good job trying to, one thing is to lecture and another thing is to understand. If you look so far, the journey of this class, I really take my time to listen to the lecture, and that's why I say I don't really have time to ask questions, except for a few areas where I feel I need a clarification on the practical aspect of it. So I'm really grateful. I appreciate every one of us in this class. Thank you so much, sir.
Thank you very much, Madam Isufu. Okay, who else? Mr. Demi?
Thank you, Prof. Let me borrow Esther's language. My expectation is overmet, and everything I've read about you before the workshop, I think you've surpassed. What makes this workshop stands out for me, it's your wealth of knowledge. Like Esther was explaining to us, it's a different thing to know the theoretical aspects of things, and it's a different thing entirely to be able to, put it into practice and teach your audience the practical aspect to it. So the Prof, that's what you've done. And on this note, let me crave your indulgence that for somebody like me who seems to have skipped some of the lectures, one promise I will make to you is that I will make sure I find time to go over everything, all the videos. And you know what that means. As I start going over those videos, be expecting a lot of bombardment from me. Thank you, Prof. God bless you. Really good. Thank you.
Thank you, sir. Mr. Balogun, are you there?
All right. Yes, sir. First and foremost, let me just appreciate you because when I was writing my ICANN exam, I was not privileged to attend lecture. I only read almost everything by myself, especially the professional stage. So most of my studies was just, accepting it the way it is, and fortunately, I was able to, find myself in a place where I need to be practicing it. So it has become, before now, it has become issues, especially whenever I'm appointed to be, training some staffs with regards to some little things on IFRS and all of that. So I must appreciate you because this particular workshop has actually opened my understanding, and it has given me a confidence. There's a confidence, what's it called? You have that, that confidence will give you ability to, to attend to different. So I must confess that the confidence is enhanced, and then all of those lectures, I try as much as possible to pay closer attention to them, and what's it called? The one I missed, and I've been able to, create time to, listen to it over and over. Thank you very much, sir. So the aspect I really appreciate more, I appreciate everything, almost everything. So the aspect I appreciate more is the aspect of deferred tax, because deferred tax itself, I said deferred tax, income tax in general, because I know that's the what's it called, income tax. Many people run away from it, especially off record now, especially at my place of work. People run from, because of the complexity in the standard. Same thing also applies to all of these 15, although we've not done that, and I'm hoping that I'm going to get a higher value from the IFRS 15, which is revenue. So Thank you very much, sir. So I appreciate it.
Okay, thank you. Now, first, you said 15 is not done. You have not gone through it at your self-pace. Do you get what I'm saying?
Okay. Probably you've sent the link, but I'm not.
No, we've done that. Remember, there's a certain day we are to do it, and most of you are not available. I will make it a self-paced, part 1 to part 3, with their models and everything, which you have not exactly. Okay.
All right. Thank you, sir.
Thank you. Okay, Madam Dari.
Good afternoon, sir.
Good afternoon.
I hope I'm clear, sir.
Yes, we can hear you. We can hear you.
Okay. Thank you, sir. Yes, sir, I want to appreciate your efforts so far, sir. My expectations were met and over as well. And I want to use the opportunity to appreciate my boss, Mr. Nii, Mr. Bidapun, for the great opportunity that he gave to me to be part of this workshop, because he actually picked this workshop for me to attend with him as well. So I want to appreciate him for that also. And to be truthful, I've not been able to watch all the videos, but the classes that was I fully attended, I had it was so interesting, and I gained a lot of knowledge as well. So I also want to promise that I'll try as much as possible to also go to all the videos and then come up with my own questions if I have any, and I'll get through to you, sir. So thank you very much. We appreciate, and God bless you, sir.
Yeah, thank you very much.
And again, also, I want to tell you that I knew you also in WISE when I was doing my ICANN as well.
Okay, thank you very much, man.
Thank you, sir.
Yeah. Okay. Also, again, remember that learning is a journey, is a process, it's continuous. Even when you've learned, you unlearn, you relearn, and also things like that. It's a cycle. Okay, let's continue to do that, and let's do that by trying to take something away. And also let us learn by trying to understand the fundamental rudiment and principles so that we can be able to apply things to various changing situations and dynamic situations that we might come across. And that is critical to us. And also in the course of going back to all of those videos, also use it in tandem with the class notes, with the workbooks, and with any other resource material we've given to you and the one you can lay your hands on, okay? And try to more or less domesticate whatever learning objective you've achieved in the course of your personal and self-paced learning. And I really appreciate you guys. And the beauty of it is that this is to demonstrate that we can always have whatever we desire in this part of the world by taking concerted efforts to do things differently in order to harness value. And imagine our methodologies, our approaches, our concentration are put together in our tertiary education level, and also during the period we are trying to acquire professional expertise. You see that Nigeria will have been a better place where professionals will have more or less created more value and productivity in the larger economy. And this is on accounting and finance field. Imagine similar things are replicated across all fields and see where Nigeria will have been. Probably we'll be competing with the likes of great talent in China, great talent in India, in the US, in the UK, in France, and the like. But what we have here is much more, we are being theory-based economy rather than theory and application that can now turn to productivity. But I believe the best time we will have done what we have done is 20 years ago, according to the Chinese proverb. Another best time is now, which we must not defer to the future. Thank you very much. And I really appreciate meeting you guys, those I've met before and those that I'm meeting newly. And I believe better opportunities will be for us to continue to relate. And there will also be special program going forward on critical areas, like we might have a special program where we'll be looking at contemporary issues in the business world or as it affects organizations, which will turn into things like webinar or a training session that will just be like a day, 2 days program, okay? The workshop program is usually for general knowledge, which spans through all facets of IFRS standards, including live classes and self-paced and other materials. Therefore, in this slide, I'll say we come to the end of the workshop, but again, it has not ended, all because we have our resource videos of our live classes, of our self-paced classes, and also we have materials. We can also continue to ask questions and give answers or suggested solutions to whatever our discussions are in the course of our platforms, okay? And also, you'll be our ambassador to more or less bringing more professionals to the net, because today's world is a knowledge world, knowledge-driven world. The more people have knowledge, the better for all of us all. Gone are those days where you hide knowledge, you hide information. It must only be me. But today, you create competition, healthy competition through knowledge dissemination, whereby at the end of the day, we all contribute to the bucket of knowledge and skills. And we more or less make the world and our country and our companies, our businesses great once again. Thank you very much, guys, and God bless you all. Bye.
Thank you so much, sir. God bless you, sir.
Thank you, sir.
Bye.